You know what nobody tells you when you're starting out? That investing isn't complicated. It really isn't. We make it complicated. The financial industry makes it complicated because complicated sells. Complicated justifies fees. But the truth? The real truth? Building wealth is simple. Not easy, mind you. Simple and easy are two different things. Simple means the principles are straightforward. Easy means they don't require discipline. And discipline, that's what separates the people who build real wealth from the people who just talk about it. I've been investing for over 50 years now. Started when I was in my 20s with almost nothing. A few $100 here, 1,000 there, and I made every mistake you can imagine. I bought stocks because my neighbor said they were hot. I sold when I got scared. I tried to time the market. I chased returns. I did all the things you're not supposed to do. And you know what? I learned. That's the only good thing about mistakes. If you're willing to learn from them, they become lessons instead of losses. So today, I want to share what I've learned. Not theories from textbooks. Not strategies from some guru who's never actually invested their own money. Real lessons. Practical wisdom. The kind of stuff that actually works when you're trying to build wealth over decades, not days. The foundation: understanding what investing really is. Let's start at the beginning. What is investing? Most people think investing is buying stocks, picking winners, finding the next big thing. That's not investing. That's speculation. And there's nothing wrong with speculation if you know that's what you're doing. But don't confuse it with investing. Investing is putting money into productive assets that generate returns over time. That's it. You're not trying to outsmart anyone. You're not trying to predict the future. You're simply putting your capital into things that produce value. Businesses, real estate, even your own education and skills. Think about a farmer. A farmer plants seeds in the spring, waters them, tends them, and in the fall, harvests crops worth more than the seeds cost. That's investing. The farmer isn't trying to guess what wheat prices will be next Tuesday. The farmer is producing value. That's how you need to think about your money. You're planting seeds, financial seeds. And if you're patient, if you tend them properly, they'll grow into something substantial. The power of compounding. The eighth wonder. Here's something that will change your life if you really understand it. Albert Einstein supposedly called compound interest the eighth wonder of the world. And he was right. Compounding is the most powerful force in finance. More powerful than any stock pick. More powerful than any market timing strategy. More powerful than anything. Let me give you an example. Say you invest $10,000 at age 25, and it earns 8% per year. You never add another penny. Just let it sit there for 40 years until you're 65. How much do you have? Take a guess. $217,000 from a single $10,000 investment. That's compounding. Your money makes money, and then that money makes money, and then that money makes money. It snowballs. But here's the thing about compounding. It requires time. You can't rush it. You can't force it. The money needs years to work. Decades, really. And that's why most people never benefit from compounding. They don't give it enough time. They get impatient. They pull money out. They switch strategies. They interrupt the process. I have a friend who started investing at 30. Another friend started at 40. Both invested the same amount each month. Same investments, same returns. But the one who started at 30, by retirement, they had almost twice as much. Not because they were smarter, not because they picked better stocks, just because they had 10 more years for compounding to work. Those 10 years doubled their wealth. That's not magic. That's mathematics. That's compounding. And the earlier you start, the more dramatic it gets. The three-fund philosophy. Simplicity over complexity. Now, I know what you're thinking. Okay, I understand compounding. But what do I actually invest in? And this is where people get lost. They think they need to analyze companies, read financial statements, watch CNBC all day. You don't. For most people, the best investment strategy is also the simplest. 3 funds. That's it. A total U.S. stock market index fund, a total international stock market index fund, and a total bond market index fund. 3 funds. Done. Why does this work? Because you're not trying to beat the market. You're trying to capture the market's returns with minimal cost and maximum diversification. You own a piece of thousands of companies across every sector, every industry, every geography. You're betting on human progress, on innovation, on economic growth. And over long periods, that's a very good bet. I know some of you are thinking, that sounds boring. Where's the excitement? Where's the potential for huge gains? And I understand that. When you're young, when you have energy and ambition, index funds feel too passive, too slow. But let me tell you something. I've known hundreds of investors over my lifetime. The ones who got rich slowly with boring index funds, they're still rich. The ones who tried to get rich quickly, most of them aren't rich at all. Some of them lost everything. There's a famous study, maybe you've heard of it, where they tracked the returns of various investors, professional fund managers, individual stock pickers, and they compared them to a simple index fund. Over 10 years, about 85% of professional managers underperformed the index. Over 20 years, over 90% underperformed. These are professionals, people who do this for a living, people with teams of analysts, sophisticated models, insider access, and they can't beat a simple index fund. What makes you think you can? Asset allocation, the only free lunch. Chinties. There's an old saying in investing, asset allocation is the only free lunch. What does that mean? It means by spreading your money across different types of investments, stocks, bonds, real estate, cash, you can reduce your risk without reducing your expected returns. That's rare. Usually in investing, more return means more risk. But with diversification, you get better risk-adjusted returns. Here's how I think about it. Imagine you're a chef making soup. If you only use one ingredient, the soup is going to be one-dimensional. Boring. Maybe even inedible if that one ingredient goes bad. But if you use multiple ingredients, vegetables, spices, broth, you get depth, complexity. And if one ingredient isn't great, the others compensate. That's asset allocation. You're mixing ingredients to create a balanced portfolio. And the mix depends on your situation, your age, your risk tolerance, your goals, your timeline. When you're young, you can afford to take more risk. You have time to recover from downturns. So maybe you're 90% stocks, 10% bonds. When you're older, approaching retirement, you need more stability. Maybe 60% stocks, 40% bonds. There's no perfect formula. It's personal. But here's what I've learned. The worst thing you can do is be all in one thing. All stocks, all bonds, all real estate, all cash. Because when that one thing does poorly, and eventually everything does poorly, you have no protection, no cushion. You just take the full hit. I saw this in 2000 with tech stocks. People who were 100% in technology companies. They lost 80%, 90% of their wealth when the bubble burst. If they'd been diversified, if they'd owned bonds, value stocks, international stocks, they would have lost some money, sure. But not everything. Not their future. The psychology of investing. Your mind is your biggest enemy. Now we get to the hard part. Not the technical stuff, the mental stuff. Because here's the truth. Investing is 80% psychology and 20% strategy. You can have the perfect portfolio, the perfect plan, the perfect strategy. But if you can't control your emotions, you'll fail. Let me explain what I mean. Markets go up and down. That's what they do. Over long periods, they go up more than they go down, but there's volatility, ups and downs. And when markets go down, when your portfolio loses value, your brain starts screaming at you. Sell! Get out! Save what you can! This is panic. This is fear. And it's natural. We're wired for this. Our ancestors who panicked and ran when they heard a noise in the bushes, they survived, The ones who calmly analyzed the situation, sometimes they got eaten. So this fear response, it's in our DNA, but it's terrible for investing. Because when you panic and sell during a downturn, you lock in your losses. You turn a temporary decline into a permanent loss. And then, when the market recovers, and it always recovers, you're sitting on the sidelines in cash. You miss the gains. This is the single biggest mistake investors make. Selling low, buying high, doing the opposite of what they should do, and it happens because they let their emotions override their logic. I remember 2008, the financial crisis. My portfolio dropped 40%. 40%. I logged into my account and saw hundreds of thousands of dollars gone. Just vanished. And I felt sick. Physically sick. My stomach churned. I couldn't sleep. And every instinct I had said sell. Get out before it gets worse. But I didn't sell. You know why? Because I'd been through downturns before. Because I knew the history. Because I understood that markets recover. And more importantly, because I had a plan, and I stuck to it. I didn't look at my portfolio for 6 months. I just kept contributing, kept buying. And when the market recovered, when we hit new highs in 2010, 2011, 2012, I wasn't just back to even. I was way ahead. That's discipline. That's controlling your emotions. And it's the hardest thing you'll ever do as an investor. The dangers of comparison. Run your own race. Here's something that will absolutely sabotage your investing success. Comparing yourself to others. Your brother-in-law who made a killing on some cryptocurrency. Your coworker who bought a stock that doubled in 3 months. Your neighbor who's flipping houses and driving a new car. Stop. Just stop. You're not in a race with anyone else. You're running your own race, your own journey. And the only comparison that matters is, am I better off than I was last year? Am I progressing toward my goals? I had a cousin who was obsessed with beating the market. Every family gathering, he'd talk about his returns, how he was up 30% this year, how he found this amazing stock. And for a few years, he did great. Better than me. Better than most people. But he took huge risks, concentrated positions, leverage, speculation. And then, one bad year, he lost 60% of his portfolio, wiped out years of gains. Meanwhile, I was plodding along with my boring index funds. 7% a year, 8% a year. Nothing exciting, nothing to brag about at parties, but consistent, steady. And over 20 years, I'm so far ahead of him, it's not even close. Slow and steady wins the race. That's not just a saying, it's the truth. The tortoise really does beat the hare in investing. But you have to be comfortable being the tortoise. You have to be okay with watching other people seemingly get rich faster than you. You have to trust the process. Tax efficiency. Keeping more of what you earn. Let's talk about something most people don't think about. Taxes. And I get it. Taxes are boring. They're complicated, but they matter a lot because it's not about how much you make. It's about how much you keep. Here's an example. Say you have 2 investments. One makes 10% per year, but generates a lot of taxes. Another makes 8% per year, but is tax efficient. Over 30 years, which one leaves you with more money? The 8% one. Because taxes compound too. Every dollar you pay in taxes is a dollar that can't compound for you. So how do you invest tax efficiently? A few ways. First, use tax-advantaged accounts. 401, Ks, IRAs, Roth IRAs. These accounts let your money grow without annual tax bills. That's huge. If you're not maxing out these accounts, that should be your first priority. Not picking stocks, not finding the hot investment. Maxing out your tax-advantaged space. Second, when you do invest in taxable accounts, favor index funds. Why? Because they have low turnover. They don't trade much, and every trade generates potential taxes. Active funds, on the other hand, trade constantly. They generate capital gains, and you pay taxes on those gains every year, even if you didn't sell anything. Third, Think about asset location. Put your tax-inefficient investments, bonds, rates, actively managed funds, in tax-advantaged accounts. Put your tax-efficient investments, index funds, stocks you hold long-term, in taxable accounts. This way, you're shielding the investments that generate the most taxes. I know this sounds complicated, but trust me, over a lifetime, tax efficiency can add hundreds of thousands of dollars to your wealth. Maybe millions. It's that important. The 4% rule. Making your money last. At some point, if you do this right, you'll accumulate a substantial nest egg. And then comes the question, how do I use this money? How much can I withdraw without running out? There's a guideline called the 4% rule. It says you can withdraw 4% of your portfolio in the first year of retirement. Then adjust for inflation each year after. And your money should last at least 30 years. So if you have $1 million, you can withdraw $40,000 the first year, then adjust that $40,000 for inflation going forward. Now, the 4% rule isn't perfect. It's based on historical data. It assumes certain returns and inflation rates. In reality, your experience might be different, but it's a good starting point, a good rule of thumb. And here's what's interesting. To support a $40,000 annual withdrawal, you need $1 million. To support $80,000, $2 million. The math scales. So when you're working, when you're saving, you can work backwards. How much do I need in retirement? What lifestyle do I want? That tells you how much you need to save. For me, I always aimed high. I wanted a bigger cushion, so I saved more than the minimum. I lived below my means, and now in retirement I have security. I have flexibility. I don't worry about money. And that peace of mind, that's priceless. Avoiding the big mistakes. What not to do. We've talked a lot about what to do, but let me tell you what not to do. Because, in investing, avoiding mistakes is just as important as making good decisions. First, don't try to time the market. Don't wait for the perfect moment to invest. Don't try to sell at the top and buy at the bottom. You can't do it consistently. Nobody can. Even the professionals get it wrong. So just stay invested. Keep putting money in regularly. Ignore the noise. Second, don't chase performance. Don't buy last year's hottest fund or stock. Performance chasing is a loser's game. The funds that did great last year, they usually don't do great this year. It's called regression to the mean. Things that outperform eventually underperform. Things that underperform eventually bounce back. That's how it works. Third, don't pay high fees. Every dollar you pay in fees is a dollar that doesn't compound for you, so favor low-cost index funds. Avoid actively managed funds with expense ratios over 1%. Avoid financial advisors who charge 1% or more just to put you in expensive funds. Fees compound too. Over a lifetime, high fees can cost you 30%, 40%, even 50% of your potential wealth. Fourth, don't panic during downturns. We talked about this already, but it bears repeating. Downturns are normal, expected, part of the process. If you can't stomach a 30% or 40% decline, you shouldn't be invested in stocks. Adjust your allocation. Add more bonds, but don't panic and sell at the bottom. Fifth, don't invest money you need in the short term. Stocks are for long-term money. Money you won't need for 5 years minimum, preferably 10 or more. If you might need the money sooner, keep it in cash or bonds. Because if you invest short-term money in stocks and the market drops right when you need the money, you're forced to sell at a loss. That's devastating. Building the habit. Making it automatic. Here's a secret that successful investors know. Investing isn't about making heroic, brilliant decisions. It's about building good habits, automatic behaviors, systems that work without you having to think about them. The best system? Automatic contributions. Set up your 401k contribution. Set up automatic transfers from your checking account to your investment account. Set it and forget it. That way, you're not relying on willpower. You're not relying on discipline. It just happens. Like paying a bill. I've done this for decades. Every paycheck, money automatically goes into my investment accounts. I never see it. I never touch it. It's just gone, invested. And over the years, it's become such a habit that I don't even think about it. I budget based on what's left after the automatic contributions. I've adjusted my lifestyle to live on 70%, 80% of my income. The rest? It's invested before I can spend it. That's how you build wealth. Not through brilliance, through systems, through automation, through consistency. The long game, playing for decades, not days. Everything I've told you today boils down to one principle. Think long-term. Don't think about next month or next year. Think about 10 years from now, 20 years, 30 years. What will your older self thank you for? I'm in my 70s now, and I can tell you with absolute certainty, my older self is incredibly grateful to my younger self. Because my younger self made good decisions, saved consistently, invested wisely, stayed disciplined, and now I have security. I have freedom. I have options. You have that same opportunity. Right now, today, you can start building the foundation for a secure financial future. It doesn't require genius. It doesn't require luck. It just requires commitment, consistency, patience. Start small if you need to, $50 a month, $100, whatever you can afford. But start, and then stay consistent. Keep going, year after year, decade after decade. Let compounding work its magic. Let time be your ally. Because here's the final truth. Time in the market beats timing the market. Every single time. The best investors aren't the smartest. They're not the luckiest. They're the most patient, the most disciplined, the ones who start early and never stop. So make the commitment today, not tomorrow, not next month. Today, open an account, set up automatic contributions, choose your investments, and then let it run. Don't touch it. Don't panic. Don't get cute. Just let it compound. 40 years from now, you'll look back on today as the day everything changed. The day you took control of your financial future. The day you became an investor. And trust me, your future self will thank you. The journey of 1,000 miles begins with a single step. Your journey to financial security begins with a single dollar invested. Start today. Real estate, the other wealth builder. Now, I want to talk about something we haven't covered yet. Real estate. Because while stocks are fantastic, they're not the only way to build wealth. Real estate has created more millionaires than probably any other asset class. And for good reason. Real estate gives you something stocks don't. Leverage that actually makes sense. When you buy a house with a mortgage, you're putting down 20% and borrowing 80%. But you control the entire asset. You benefit from the appreciation on the whole property, not just your down payment. That's powerful leverage. Controlled leverage. Not the dangerous kind we talked about earlier with margin loans. Let me give you an example. Say you buy a house for $300,000. You put down $60,000. That's 20%. The house appreciates 5% per year. In 10 years, that house is worth about $490,000. You made $190,000 in appreciation. But your initial investment was only $60,000. That's more than a 300% return on your down payment. Plus, your tenants were paying down your mortgage the whole time if you rented it out. Now, real estate isn't passive like index funds. It takes work. You've got to find properties, manage tenants, handle repairs, deal with vacancies. But if you're willing to put in that work, the returns can be exceptional. I bought my first rental property when I was 32, a small duplex. I was terrified. What if I couldn't find tenants? What if something broke? What if I couldn't afford the mortgage? But I did my homework. I bought in a good area. I priced it fairly. And it worked out. That duplex has been paying me rent for over 40 years now. It's worth 10 times what I paid. And the rental income has increased steadily with inflation. Here's my advice on real estate. Start small. One property. Learn the ropes. Understand what you're doing before you scale up. And focus on cash flow, not just appreciation. You want properties that generate positive cash flow from day one. That way, even if the market stagnates, you're still making money every month. Also, location matters enormously. You've heard it a million times. Location, location, location. And it's true. A mediocre property in a great location will outperform a great property in a mediocre location every single time. So buy in areas with good schools, low crime, job growth, infrastructure, places where people want to live. And one more thing about real estate. Don't fall in love with properties. This is business. This is investing. If a property stops making sense financially, sell it. Don't hold on for emotional reasons. I've seen too many people lose money because they got attached to a building. Buildings are just assets. Treat them that way. The emergency fund, your financial foundation. Before we go any further, I need to talk about something fundamental. Something that comes before investing. Your emergency fund. Because if you don't have an emergency fund, you're building your financial house on sand. An emergency fund is 3 to 6 months of expenses in cash. Not invested, not in stocks or bonds. Cash. In a savings account. Boring, safe, liquid cash. Why? Because emergencies happen. Cars break down. You lose your job. Medical bills come up. The roof leaks. And when these things happen, you need money immediately. If you don't have cash, you're forced to either go into debt or sell investments at the worst possible time. Practice. I learned this lesson the hard way. Early in my career, I was so eager to invest that I put every spare dollar into the market. I had maybe $1,000 in savings, and then my car died. Completely dead. Needed a new engine. $4,000. I didn't have it, so I had to sell some stocks. And of course, this was during a downturn. I sold at a loss. Locked in that loss permanently. All because I didn't have an emergency fund. So after that, I vowed never to be in that position again. I built up 6 months of expenses in cash. Took me about a year. And once I had that cushion, everything changed. I slept better. I felt secure. And I could invest more aggressively with my remaining money because I knew I had a safety net. So if you don't have an emergency fund, that's your first priority. Before you invest a single dollar in stocks, build that fund. It might feel slow. It might feel like you're missing out. But trust me, you're building a foundation. And a strong foundation is what lets you build wealth that lasts. Teaching the next generation the gift of financial literacy. One of my biggest regrets is that I didn't teach my kids about money earlier. I was so focused on making money, on building wealth, that I didn't take the time to really explain it to them, to show them how it works. And they struggled because of it. They made mistakes I could have helped them avoid. Don't make that mistake. If you have kids, teach them about money. Start young. Give them an allowance. Let them make decisions. Let them make mistakes with small amounts. Because those mistakes are cheap lessons now. They're expensive lessons later. I remember when my son was 8. He wanted this toy. Cost about $20. He'd been saving his allowance for weeks. And when he finally had enough, we went to the store. He bought the toy, played with it for about 2 days, and then it sat in the closet. A few weeks later, he wanted a different toy. But he'd spent his money. He was frustrated. Why didn't I have money? I just got paid allowance. And that was the lesson. Money is finite. Once you spend it, it's gone. You have to choose. And sometimes, waiting and saving for something better is smarter than buying the first thing you want. These are lessons that serve kids for life. Delayed gratification, opportunity cost, the power of saving. If they learn these things young, they'll be so far ahead of their peers. And as they get older, teach them about investing. Show them your portfolio. Explain how it works. Let them pick a stock or a fund and track it. Make it real, make it tangible. Because financial literacy is one of the greatest gifts you can give the next generation. The role of side hustles, accelerating your journey. Here's something I wish I'd understood earlier. Your income isn't fixed. You're not stuck with whatever your job pays you. You can earn more, and earning more accelerates everything. I'm not talking about working yourself to death. I'm talking about strategic side income, using skills you already have to generate extra money, and then investing that extra money aggressively. Let me tell you about my friend Sarah. She was a teacher, made okay money, but nothing special. But she loved photography, had a good eye. So she started doing wedding photography on weekends. Just a few weddings a year at first, made an extra $5,000, $10,000. And she invested every penny of it. Over 10 years, that side income, all invested, grew to over $200,000. $200,000 from wedding photography. That wasn't her main career. That was just extra. But she was disciplined. She didn't spend that money. She invested it. And now she's retiring 5 years earlier than she planned because of that extra nest egg. That's the power of side income. You take your primary income, use it to live on. And you take your side income, invest it aggressively. It supercharges your wealth building. And in today's economy, side hustles are everywhere. Freelancing, consulting, tutoring, driving for rideshare services, renting out a spare room, online businesses. The opportunities are endless. You just have to be willing to put in some extra hours. Now, I'm not saying work 80 hours a week for 30 years. That's not sustainable. But a few extra hours on weekends, a few hours in the evenings, for 5, 10 years, that can change your entire financial trajectory. Market bubbles. Recognizing irrational exuberance. Let's talk about something dangerous. Market bubbles. Because they happen. They've happened throughout history. And they'll happen again. And if you're not careful, they can destroy your wealth. A bubble is when asset prices rise far beyond any reasonable valuation. When people are buying not because the asset is worth it, but because they think someone else will pay even more. That's speculation. That's gambling. And it always ends badly. I've lived through several bubbles. The dot-com bubble in the late 90s, the housing bubble in the mid-2000s, various cryptocurrency bubbles, and they all have the same characteristics. First, prices rise rapidly, way faster than historical averages. Second, everyone's talking about it. Your barber, your taxi driver, your grandmother, they're all giving you investment tips. Third, there's a narrative, a story about why this time is different, why the old rules don't apply, why these prices make sense. And fourth, there's fear of missing out. FOMO. Everyone around you is making money. They're bragging about their gains, and you feel like an idiot for not participating. The pressure to join in becomes almost unbearable. That's how bubbles suck people in, and then, inevitably, they pop. The prices crash. People panic, and fortunes are lost. I remember the dot-com bubble vividly. Companies with no revenue, no profits, no real business model. They were worth billions of dollars. People were quitting their jobs to day trade. Everyone had a story about some stock that tripled in a month. And the narrative was, the internet changes everything. Old metrics don't matter. It's a new economy. I stayed away. People thought I was crazy, old-fashioned, out of touch. But I stuck to my principles. I invested in profitable businesses with real earnings. And when the bubble burst in 2000, when those dot-com stocks fell 90%, I was fine. Here's how you avoid bubbles. Stick to fundamentals. Ask yourself, what is this asset actually worth based on the income it generates? If you can't answer that question, don't invest. And if everyone around you is getting rich quick on something, be skeptical. Very skeptical. Quick riches are almost always illusions. Real wealth is built slowly. Boring lie. Over decades, not months. Health as wealth, the most important investment. Here's something that might surprise you. The best investment you can make isn't in stocks or real estate, it's in your health. Because without your health, nothing else matters. You can have all the money in the world, but if you're sick, if you're in pain, if you can't enjoy life, what's the point? I've watched friends accumulate tremendous wealth, only to spend it all on medical bills in their later years. I've watched people work themselves into heart attacks chasing money. I've watched brilliant investors let their health deteriorate because they were too focused on their portfolios. Don't make that mistake. Invest in your health now. Eat well, exercise regularly, get enough sleep, manage stress, see doctors for preventive care. These aren't expenses, they're investments. Investments in your future quality of life. And here's the thing, good health compounds too, just like money. When you're healthy, you have energy. You think clearly, you're more productive, you make better decisions, you live longer. And all of that amplifies your ability to build and enjoy wealth. I'm in my 70s, and I still exercise 5 days a week. Nothing crazy. Walking, swimming, some light weights. But I'm consistent, and I'm healthier than many people half my age. I can travel. I can play with my grandkids. I can enjoy my retirement, because I invested in my health for decades. So yes, save money, invest wisely, build wealth, but don't sacrifice your health doing it. Find balance, because wealth without health is just numbers on a screen. The danger of lifestyle creep. Keeping your expenses low. We touched on this earlier, but I want to go deeper. Lifestyle creep. Lifestyle inflation. Whatever you call it, it's one of the biggest obstacles to building wealth. Here's how it happens. You get a raise. Suddenly you're making 20% more. And you think, great, now I can afford that nicer apartment, that new car, those fancy dinners. And before you know it, your expenses have increased 20%. You're not saving any more than before. You're just spending more. This is the trap. The treadmill. You make more, you spend more, you never get ahead. I've seen people earning $200,000, $300,000 a year who are living paycheck to paycheck because of lifestyle creep. The solution? Every time you get a raise, save at least half of it, preferably more. Let's say you get a 10% raise. Save 7%, spend 3%. That way your lifestyle improves slightly, you don't feel deprived, but most of the increase goes toward your future. I've followed this rule my entire career. When I got promoted, when I got bonuses, I immediately increased my automatic investment contributions. The money never hit my checking account. I never got used to having it. And over the years, my savings rate went from 10% to 15% to 20% to eventually 30% of my income, all while my lifestyle improved modestly. That's how you build real wealth. Not by earning more and spending more, by earning more and saving more. And here's a secret. After a certain point, more spending doesn't make you happier. Research shows that happiness increases with income up to about $75,000 a year. After that, more money doesn't really increase happiness. So if you're above that threshold, additional income should go towards savings, not spending. I know people making $50,000 who are happier than people making $500,000. Why? Because the $50,000 person lives within their means, has savings, has security. The $500,000 person is stretched thin, stressed out, worried about maintaining their expensive lifestyle. Choose happiness over appearance. Choose security over status. Choose wealth over stuff. Giving back, the ultimate purpose of wealth. Finally, I want to talk about something that gives wealth meaning. Giving back. Philanthropy. Generosity. Because at the end of your life, you're not going to be remembered for your portfolio balance. You're going to be remembered for what you did for others. I didn't always think this way. When I was younger, I was focused on accumulation. How much can I build? How wealthy can I become? And there's nothing wrong with that phase. You need to secure your own financial future first. But once you've done that, once you have enough, the question becomes, what now? What's the purpose of all this wealth? And for me, the answer is giving back. I started small, donating to local charities, helping friends in need, volunteering. And I discovered something surprising. Giving feels better than accumulating. The joy of helping someone, of making a real difference in someone's life, it's more satisfying than watching your portfolio grow. Now, I'm not saying give away everything. I'm not saying you shouldn't enjoy your wealth, travel, enjoy hobbies, live comfortably. You've earned it. But also think about legacy. Think about impact. Maybe it's funding scholarships for kids who can't afford college. Maybe it's supporting medical research. Maybe it's helping your own family. Maybe it's starting a foundation. Whatever resonates with you. I have a friend who built a very successful business, sold it for millions, and now he spends his time teaching financial literacy in low-income communities. He doesn't need the money. He's set for life. But he wants to help others avoid the mistakes he made. He wants to give people the knowledge he wished he'd had. That's purpose. That's meaning. That's what wealth enables. So, yes, build wealth. Absolutely. Be smart, be disciplined, be patient. But also think about why. What's the ultimate purpose? For me, it's security, freedom, and the ability to help others. Figure out what it is for you. Final thoughts. Your journey starts now. We've covered a lot today. Compounding, asset allocation, psychology, real estate, emergency funds, side hustles, bubbles, health, lifestyle creep, giving back. It's a lot to absorb. But the core message is simple. Building wealth is a marathon, not a sprint. It requires patience, discipline, and consistency. But it's absolutely achievable for anyone willing to commit to the process. You don't need to be brilliant. You don't need to be lucky. You don't need to come from wealth. You just need to start. Today, right now. And then keep going. Year after year. Decade after decade. I started with almost nothing. A few $100s, a modest salary. But I was consistent. I saved, I invested, I learned, I adapted. And over time, it compounded into something substantial. Something that gives me security, freedom, and the ability to live life on my terms. You can do the same. The path is clear. The principles work. The only question is, will you commit? Will you start? Will you stay the course when it gets hard? When markets fall? When others are panicking? I believe you will. Because you're here, you're learning, you're taking this seriously, and that puts you ahead of most people. So make the decision today. Not tomorrow. Today. Open that investment account. Set up automatic contributions. Choose your allocation. And then, let time work its magic. 40 years from now, when you're looking back on your life, on your journey, you'll remember today as the turning point. The day you took control. The day you became an investor. The day you started building real, lasting wealth. And you'll be grateful. So grateful that you started. That you stayed consistent. That you didn't give up. Your future self is counting on you. Don't let them down. Start today. Stay consistent. Be patient. Build wealth. And live the life you deserve. The journey of 1,000 miles begins with a single step. Your journey to financial security begins with a single dollar invested. Start today.